Hello everyone, my name is Adam. I'm FR tutor at Duke Williams Company Limited. Duke Williams is a gold learning provider in Ghana, and today the purpose of this video is to help our students preparing for the session CBE FR, and also to share a few exam techniques with the students. So let's get it started. Go to the ACCA website and let's search FR CBE past exams. So select FR session CBE. Want to launch March-June 2018 exam. Okay, this is the instruction session. You go next. Go next. Go next. Go next. Yes, we are ready. Okay. So want us to do the single entity question, which is question 2 here. So let's view the full page and then we can go to question 2. Otherwise we could have used the navigator as well. Okay, here we are. So single entity question, the requirement A, calculate the adjusted profit for Haverfordco for the year ended 31st December X7. B, prepare the statement of changes in equity. And then C, prepare the statement of financial position. Okay, so let's quickly go through the question to start with. Okay. Now what I do often with my students is to share with them an exam technique and to reduce a way of going in between the questions. So I'll say, okay, let's do a summary. Let's do a short summary of the question whilst we read. So below is the trial balance for Haverfordco at the 1st December X7, and we have the trial balance is in thousands of dollars, and then we have the property at current amount 1st January X7. We have ordinary shares at 1st January X7, other components of equity also at 1st January X7. We have revaluation surplus at 1st January X7, retained earnings, draft profit for the year, which you have to adjust, 4% convertible loan note, dividend, cash received from a customer, contract customer, cost incurred on contract to date. So we have to look at the notes, inventories, trade receivables, cash, current liabilities. Okay. We have property at the current amount, 1st January. Okay, but what I've often do to start with for any question as we start solving is to first highlight the cells and format it. So let me format the cells, let me highlight the cells and format. So I'll go to the currency formatting and I'll choose negatives in bracket and I'll run it to a whole number. So I'll run all my calculations to a whole number. So let me choose this one. So the formatting is done. So I have requirement A, adjusted profit, for the year ended the 1st December 20, excellent. So amount raised to 3 zeros. So now from the trial balance, I can see on the screen draft profit, so I can just draft profit. So the draft profit, I have that as 2,250. So that's what I'll adjust. So from the cell H, I want to start my working sheets. So let me build my working sheets here. So workings, and I'll say all figures are in thousands of dollars. I'll close it. Okay. So for the adjustment, yeah, let me leave few margins, and then I can always cut and drop it down. So the requirement B would come now. So my requirement B is a statement of changes in equity for the year ended December 20x7. Okay. Now for the statement of changes in equity, I know that my pro forma would have columns for share capital, we have column for share capital. I see on top there other components of equity. Well, let me bring retained earnings straight away. Retained earnings. And then I can bring the other components. So I can say other components, I do it OCE. And then I can bring revaluation surplus, because I see that up there. Revaluation surplus. Okay, so far I have 4 columns. I'll add as and when I get the details of the notes. So what I'll do is to bring the opening balances as I see them on the trial balance. So I have balance at 1st January 20x7. For share capital, the amount is 20,000. Retained earnings is 6270. For other components of equity is 3,000. For revaluation surplus is 800. Okay, so we can leave enough line, about 10 lines. if it's not enough, we can just cut and step it down, the next requirement. So let's show the next requirement, which is statement of financial position here. So C, statement of financial position as at the 1st December 20x7. Good. Now for the financial position, I know I need my assets, so let's create 2 columns, or raised to 3 zeros. Create, sorry. So to start with, I'll have my assets. Now from the trial balance, we'll have non-current, assets. Now the non-current asset, I see there is property. There's a note to it, so we'll do an adjustment to it. Let's see 2 lines for any other current non-current assets. So we can say current assets. I see inventories there. I see trade receivables. I see cash. Okay, there's a contract, there's a construction contract. So let's see about 2 lines in between, then we'll come back to it. So we can have our share capital, basically our equity and liabilities. Start with equity, then we have our share capital, our retained earnings, we have our OCE, which is the other components of equity. There's a revaluation surplus, so we leave a line or 2 and bring our non-current liabilities, if any. Okay, because I see on the trial balance we have a low note, so I'll put the 4% low note, waiting for my workings and my adjustment, sort of. Okay, can leave a line or 2 and can say our current liabilities. Okay, our current liabilities, there is an aggregate figure. So we've been able to set out our pro forma. So what we do is to take the notes and see how the notes will be dealt with. Okay, so and ensure you take it note after note. So let's look at note 1. On 1st January X7, Aberford issued $80,100 4% loan note. So 80,000 times $100, that should give you 8 million, and that figure is up here in the trial balance, so you reconcile it. The loan note can be converted to equity shares on the 1st December X9. So the issue date is 1st January X7. So X7, X8, X9, so that's 3 years. Or redeem at par on the same date. An equivalent loan note without a conversion right would have required interest of 6%. And you know, because it's a convertible loan note, and as per the IAS 32, you have to split into debt and equity. So would have to use the 6% loan note of an equivalent loan without conversion right to scoop out the debt, and we're going to use that as the discount factor. So the discount factor to be used straight away is 6%, not 4%. Take note of that. Okay, so let's do workings for this once we split out. So our workings 1 can be the loan notes, and equity option. Okay, so what we do first is to split the value. So we'll split the value. Let's do that quickly. So we have the years. Let's have years. We have cash flow. So cash flow. So I can say cash flow. I can see the dollar amount, or I can just type amount there. I can bring the discount factor, and then I'll bring present value. Now the cash flows, you know, are the interest. They are the interest, and on the redemption we'll have the principal. So what I will often do is that the interest would accrue over the 3-year period. So it means that it's year 1 to year 3, year 1 to year 3. The amount is equal to the nominal value, which is 8 million. So 8,000 times the interest on it, and the interest, which is the coupon, is 4%. So that will be 0.04, and that should be it. Now the discount factor will be the sum of the discount factors for the individual years, which will be 0.9443 plus 0.890 plus 0.840. So that should be our discount factor, but note that it is approximated to 3, but it will give us the equivalent present value. So the present value would be our cell J4 times the discount factor. So approximately we have a present value of 855. Now the principal amount on redemption will be 8,000. Now this the equivalent discount factor will be the discount factor for the 4th year, the 3rd year, that will be 0.84. Its value would be this times the discount factor. So we have this. So now we can have the total cash flow to be this cell plus the other cell. Now the loan note, so the debt, which I would say debt, will be this, and my equity would be the difference. So we know that the total should give us 8,000. Sorry, the total should give us 8,000. So basically, equity will be the difference, this minus the debt. So the equity value is approximately 425. Good, you're making progress. Now this is what you do with this. Not to forget, we have the equity option which we will need for our statement of changes in equity. So what I will do is to quickly take the equity to the statement of changes in equity. So I'll come here, not in any particular order, so because I don't want to forget. So my equity option, so I'll name it workings 1. It's workings 1, and that should be under other components of equity. So this should be equal to the equity value up there should be equal to this. So there we have it. So we have sent our equity option. Now let's build on our workings for the loan note. Now, having done the present value of the debt, let's find amortization for the first year, because the loan was issued on 1st January X7. So I would say this should be the amortized cost of loan. So the amortized cost of loan. Okay. So I'll have the year. So I'll have the opening balance, or let me say balance brought forward. That will be simpler. Then we'll have the finance cost, which is the effective interest. So the effective interest, don't forget, that will be at 6%. So effective interest. Then you have the interest, which is the coupon interest, the interest paid. The interest paid. Then we'll have the balance carried forward. So we need that for the current year end X7, and the opening balance should be equal to our loan balance, and the effective interest on it would be 6% of the opening balance. So times 0.06. Remember to keep it simple. And our interest payment should be equal to the interest we have worked it out already. Then our closing balance should be equal to this opening balance plus the effective interest less the interest paid. There we have it. So our loan note, the amortized balance is 7710 approximately. So don't forget, I want to take you to my statement of financial position. So I'll quickly go down here and look at the balance. Don't forget, this amount are in a cell E, so I'll put it there. So it's E is equal to what I have done here. Good. Now the interest on it should be used to adjust sorry, I've gone far away. Okay. The interest on it should be used to adjust the profit. So I can come here and say finance cost on loan, and this should be equal to this. Yes. Don't forget that the finance cost should be deducted from the draft profit. So I'll just put my cursor on the cell and negate it, so I can have it in bracket. Yes, simple. Okay, that should be it. So we have dealt with all the items under workings 1. Let's proceed to workings 2, which will be our note 2. Let's see what is there. During the year, our Ford Co. entered into a contract to construct an asset for a customer. So this is the construction contract. Certifying performance obligation over time. And don't forget, a person said during the year, so it's the current year. The contract had a total price of 14 million. The cost to date 1.9 are included in above trial balance. If you want to cross check, here is it, which is debit here. The cost to complete are estimated at. So quickly, I want to know the outcome of the contract to know whether it's a profit or a loss making contract, so I can apply my principle. So 14 minus 1.9 minus 7.1, sorry, it gives me 5. So it's a profit making contract. So we can look at the percentage of progress made to be able to find out the amount. At 31st December X7, the contract is estimated to be 40% complete. To date, our Ford Co. has received 1.4 from the customer, and this is shown in above trial balance. So let's see that 1.4. Okay, here is it. Okay, so let's go to our workings and see how this will affect our profit and our financial position. So this should be our workings too. So let's put this here. Our workings 2 should be contract. Should be contract. Okay. So what I want to find first is look at the profit to be recognized. So because this has not been accounted for, profit to be recognized. Very simple. Now I go down and say revenue. The revenue. Don't forget the revenue in the question is 14, so 14,000. But here is it. Look at it. It says that the contract is 40% complete, so 0.4, so is equal to, or give us the value. So let's see the cost. So the cost will be equal to let's bring bracket 1,400 plus 7,100, we close the bracket, multiply by 0.4, and you know that our recognized profit will be this minus the cost, this. So the profit to be recognized would be 2,200. So let's quickly push that to our draft profit. So let's go. So here we say contract profit and that is workings 2. All right, so let's go down there and pick it. Here is it. We're done. So let's build on the contract, and let's see whether we'll have a contract asset or a contract liability, depending on the situation. So to do that, we need our costs incurred to date. So cost to date, always keep it simple. So cost to date, we know is 1,400. Then our profit, so recognized profit, and we have that as above, which is this. Then we'll less the billed amount, which is the amount which has been received. So less amount received. We keep it simple. So it should be minus. You know why it's minus? Because we are lessing it. So the amount received so far from the contract was given as 1,000. That's 1.9. Okay, sorry, the cost to date, some error here. Let's correct that. The cost to date is 1,009. Let's correct that here, and you see the beauty of the spreadsheet, which is different from the paper. Any mistake you do, you can easily correct it. So now let me have our cost to date 919, our recognized profit 2,000. That has changed from 2,200 to 2,000. Okay, so the amount received from the customer is 1,004. So less 1,004. Okay, so this should be this plus this plus this. Very simple. So based on what we have, our contract asset is 2,500, and let's go to our financial position. We need that under our current asset, and that should be a separate asset. So we have contract asset, and that should be in the first column, column D, and that is equal to what we have up there, this. So there we have it. So we are making progress quickly. We go to the next note, note 3. Note 3 is a bonus share issue. Our third co made a 1-for-5 share issue on 31st December, and take note of the date of the issue. It's on the last day of the year, which has not yet been recorded in the above trial balance. Our third co intends to utilize the share premium as far as possible in recording the bonus issue. Good. So let's see the share premium. The share premium was what was in the other components of equity, and which has a balance of 3,000. So let's build our workings for it. So this will be our workings 3. Keep it simple. So you can say bonus issue. Now we need to find the actual share issue because it wasn't recorded. So the issue would be the share capital, which is 20,000 from our workings, times the ratio, and don't forget the ratio is 1:5, so it's 1 divided by 5. There we have it. Now I need to observe this. You see, it's 4,000. This is 4,000. Now what it means is that the share premium account alone cannot pay for the bonus, and what it means is that we have to draw on the retained earnings to be able to pay for the rest of the bonus issue. So this is what will happen. So we'll split this into share premium. Let's leave a line between. So the share premium which would be in OCI would be 3,000. Then the retained earnings, so the retained earnings will pay for it. So the retained earnings will pay for the balance, and that should be this minus this. Okay, so let's quickly go to the statement of changes in equity and put this right in there. And don't forget, we are not wasting time on it. So bonus issue is working 3. Now the bonus issue would be increasing the share capital, so which is this one. We enter it. Then retained earnings will go down by 1,000. Let's bring it by 1,000. Now don't forget, this is a deduction, so I'll put a negative there to reduce it. Then the other components of equity, which is in the share premium, I'll have I'll have the 3,000 taken from it down there. I'll have the 3,000 taken from it. This is looking good. So let's negate it. Minus. There we have it. So the reconcile. So the 4,000 has been split 2,000 and then 3,000. Okay, quickly. Let's go to note 4, which is on the property. Alford Coast property had previously been revalued upwards, leading to the balance on the revaluation surplus at 1st January. So that is 800. Yes. So there was a balance in there. The property had a remaining life of 25 years at 1st January. Okay. At 1st December, the property was revalued at 16. No entries have yet been made to account for the current year's depreciation charge or the property revaluation at 31st December X7. Our code does not make an annual transfer from the revaluation surplus, okay, in respect of excess depreciation. All right, let's that should be our workings for. So let's deal with it quickly. Workings for. So workings for property. So now what we do is to look at the schedule for the property. So we say property. Okay, let me do it this way. Balance go forward on it is 18,000. Then I'll bring the depreciation. To keep it simple, the depreciation would be this divided by 25, but it's 25 years at 1st January. So there we have it. And don't forget, the depreciation is a deduction, so I will negate it so I can have my bracket. Then I will have balance carry forward. I have my balance carry forward, and this should be equal to this plus the depreciation. And I said plus because I have negated the depreciation. But ensure you keep it simple. You can as well leave out the bracket, and then you build your balance carry forward as the opening balance 18 minus the cell K 31. That also will give you the value. Okay, so let's leave a line in between and bring our revalued amount. So revalued amount. The revalued amount as at the end of the year, that was 16 million, so 16,000. Clearly there's a loss on revaluation, so loss on revaluation because the balance has gone down. So this loss would be this minus this. There we have it. Now this loss, because we had a balance in the statement of changes in equity, which was a revaluation surplus, we have to split it so that the excess can be debited to P&L, and that would have reduced the profit. So let's do that quickly. So you can say debit revaluation surplus. So revaluation surplus. So we are debiting revaluation surplus with the 800 and we'll credit asset. Look at it carefully, which is property. We'll credit the property with the total amount of the loss, which is here, that is needed to reduce the balance. Sorry, it is equal to 1280. Yeah. So the remaining debit would be P&L. So we'll debit profits, or we just say P&L. So debit P&L, which is the difference, this minus this. There we have it. Good. So now let's bring the items under our statement of changes in equity. So what we do is to bring the revaluation, loss, and that should take away this. So this is equal to the 800 because we are lessening it, and that should be a minus here. Okay, good. Now we can go to the financial position and bring our property balance. Our property balance is 16,000 because that's the new amount. That's the new amount. So that's it. So there we have it. It's 16 on the property, and then we have our P&L to work on. So basically we have the depreciation on the property. So the depreciation on property. Okay, let's bring our workings. This workings 4. So we say it is equal to, we go quickly down there and bring it. Here is it. There we have it. Then again bring our loss on revaluation. A loss on revaluation. A loss on revaluation should be equal to, we quickly go down there and have it. Yes. Okay, let's have a look. Don't forget it's a loss, so quickly activate and then negate it. Okay, good. Okay, now we can go to the last note. It has been discovered that inventory totaling 0.39 had been omitted, and basically if had been omitted from closing inventory, what it means is that the closing inventory at the date has been overstated. I mean the cost of sales has been overstated, so we have to reduce. So if the cost of sales has been overstated, what it means is that the effect on the draft profit is that the profit is understated. So let's just build a journal workings here. That should be our workings 5. So inventory. So basically we would have to debit, credit P&L, but in effect is we will credit the cost of sales to reduce it. So cost of sales, or it is still P&L. Then we'll debit the inventory because it has been omitted. Inventory value should go up because currently inventory is understated. So the value is 0.39, and that should be 390. 390. There we have it. Let's quickly go and work out this in our P&L. So in our P&L, I'll have inventory omitted. Yeah, inventory omitted. That should be workings 5, and that should be equal to, okay, so that we can type it here, 390, and this should increase our profit back. Then the effect on the inventory, let's do that quickly in the financial position, and this should be in cell D, equal to let's see the inventory value here. The inventory value here is 4310 on the trial balance, so plus okay, let's have it here, plus this. So that should be our inventory, and look at it. Look at it. So it's 4310 plus 390, which is the cell K42, so that the marker can go back there and look at the journal that we have added it to the inventories. Okay, so done with the notes. So let's see which items you have not brought under the current asset, because that's where we are now. I see there we have receivables, so 5510. I see we have cash, that is 10,320. Then I see we have liabilities, current liabilities. This should be here. Current liabilities 1940. 1940. Yes, that should be it. Okay, now let's come out with our adjusted profit. Now it is the auto sum, but we do it manually to say it's equal to this, and we stretch it down to the end and enter. So this is our adjusted profit. So our adjusted profit should go to the statement of changes in equity. So we'll say profit for the year. That should be, and don't forget the profit for the year should be under retained earnings. So here is equal to this. Okay, now the trial balance, I see we are here to deal with dividend, so don't forget dividend is paid out of retained earnings, so this should be equal to dividend amount is 3620. Yes, that's it. Now the dividend is a cost, so we negate it to reduce it from the retained earnings. Okay, I want to just have a last scan on the trial balance to see if I've left any item out. Okay, I think that should be it. All right, good. Let's total the statement of changes in equity quickly, starting with the share capital. So this is equal to this plus this. Then this, let's do a sum. So sum bracket, then we go up, we press Control to pull it down, and we enter. This is equal to this plus this, where we place the equity option. We could as well decide to create extra column for the equity option, but we could aggregate it under our other components of equity. And our surplus would be a negative now. It will be 0. Yeah, actually it should be 0. So we have this plus the opening balance. So that's it. So it's 0. So quickly, let's go to our financial position and see what we have. Property is working for. We have our inventories. Our share capital now should give us what we had from the total of the statement of changes in equity. So that's it. Then our retained earnings should also give us total of what we had from here. Keep it simple. Our OCE should give us what we have for the balance, which is basically the equity split from the convertible loan notes. Revaluation surplus, that should be a 0. That should be 0, yeah. You can as well decide to ignore it. Now we have our 4% loan notes and we have our current liabilities. So basically I think we've been able to exhaust the question. Yeah. Okay, I want you to observe that in my workings, apart from the P&L which I found the total, because I needed that to be able to aggregate into my equity section, and then the statement of changes in equity which I've also aggregated a total because I also needed that in my financial position. But the actual financial position I've not aggregated the totals because I might not have the luxury of time in the exam to do all that totals. And basically the items I needed are my workings to show my values, and each of the individual items I needed to give their values, and where there's working I need to do that. So I can leave out the totals for the sake of time. So here we are. We've come to the end of the question for March-June 2018, question 2, which is Haverford single entity. So on the screen you have the work done. So let me just use the split bar to show fully what we have been able to come out with. So here we are. So this is what we have been able to do. This is our work. So we're able to find this, the profit of our workings by the side, our statement of changes in equity, we have our totals by the side. Nicely done. It's always exciting to work with the CBE. Okay, thank you very much. I hope this helps in your preparation for the exam, and I hope to do other videos for the group account. So until then, all the best in the exam. Thank you.